Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mate.
Welcome to another episode of Equity Mates, where we help you learn to invest in 15 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. Great to be with you again.
As always?
Yeah.
How's the weekend been?
Yeah, it's been pretty good so far. No swans on this weekend, so just, don't know what to do with myself.
If I recall correctly, last time we recorded, it was just before the Bombers were playing against West Coast, and you were pretty adamant that they weren't going to get up.
Yeah. You were completely right.
What was the result?
Yeah, Bombers smashed them.
Smashed them, so good.
The result even looks kind to West Coast. They won by, 28 points in the end, but...
Yeah.
God, Essendon, when they want to play, they can play.
That's the issue. And then when you think they're going to win, they lose to Carlton.
Yeah, most of the time they don't want to play.
Exactly. It's tough. It's tough at the top. Anyway, so moving on, we're going to kick off today with a Basics 101. We're going to discuss buybacks. What are they? What they mean for us as investors. But I think first, Ren, will give a quick update on our trading competition.
Yeah.
We're going well.
Well, I mean,
we still have money at least.
We're a little bit dejected at this point. At least I am, because we missed out on a golden opportunity. So, to recap, our first stock that we chose was...
Well, to recap very quickly for those that may have just joined the show, you and I, Ren, are in a trading competition hosted by Stake. And we're up against 9 journalists, financial journalists from around Australia. So we are here to prove ourselves. It's for Stake's rebrand and relaunch. All profits are going to go to charity. And it's all technical analysis. We have 2 weeks to make as much money as we can trading through the Stake platform. So, yeah, recap, Ren, how'd we go?
Yeah, so we decided to try and ride an IPO to even larger highs. And we got on a company called Avalara Inc., and they do automated tax software for business. The reason we got on them, though, was they had been on the share market for about 3 days, and they'd gone up about 90%. So we thought this is an IPO that investors are loving, and we thought we'd get on the back of it. Unfortunately, on the first day, it fell 3%. So not the end of the world, but not great. And then in the second day, we decided to try and protect our risk and put a stop loss on.
Yeah, so we had the stop loss on the first night, but it was just a bit wider than the 1.5% that it dropped.
Yeah, I think it dropped more than 1.5% on the first night.
Whatever it was, 2.5%.
We're already inflating our losses to make ourselves look better. Yeah, so then in the second night, it did hit the stop loss. It fell far enough to automatically sell, which at the time was a good thing because we avoided losing any more money. But then it just shot up.
Yeah.
It was up at one stage about 25% for the day, and it closed 13% up. So we got stopped out and we missed all of the upside.
So look, big lesson to be learnt there. We would be winning the competition by a mile at the moment. I think, honestly, 3 of us are in the red, 3 of us are in the green, and I think 3 or so haven't put a trade down yet because they've come late to the game. Scott Phillips from the Motley Fool hasn't even joined yet. But we were told by Matt, who's the CEO of Stake, that we should widen our stop loss because it's quite a volatile stock. He thought 5% wasn't good enough, which we did. But in this case, widening of the stop loss still stopped us out. So, yeah, I guess the lesson there, Ren, is for a stock that's so volatile, we should have probably been a bit more less sensitive to the risk of losing money with the hope that we get it on the upside.
Yeah. So I guess now what we have to do is go away and think about what we're going to put on when markets open in America on Monday, which will be Monday night our time. So, we've
got some thinking to do. We
do. And as we said last episode, we will separately record a lot of our thinking and our planning or lack thereof during the 2 weeks, and we'll put something together that tells the story, hopefully of us winning, but probably of us participating in this competition.
Yes. Hopefully win. That'd be epic.
Yeah, it would be. It would be.
All right, Ren, well, moving on. As I said at the start, we're going to be talking about buybacks. We're going to do a basic 101, what they are, why companies do them, and some of the more notable examples that have happened recently, because we've been having some pretty huge buybacks done by some of the world's biggest companies. So let's get stuck into it.
Yeah, let's do it.
What are they? What is a buyback?
It's all in the name, really, buybacks. But it is essentially where a company goes into the open market and buys back the shares of itself. So uses spare money that it has lying around, or in some companies' cases, borrows money to go to an everyday investor like you and me, and when we're selling our shares, the company itself buys them and then essentially destroys them. So then there are less shares on issue for the rest of the market.
So why would a company want to do a buyback? It seems like if they're just going to destroy the shares, like, is it a good thing? Is it a bad thing? Why do they do it?
Yeah, so it's a good question. The theory is that it's a way for companies to return monies to shareholders that's more tax advantaged than dividends. So when a company has profits and pays its investors in dividends, investors then pay a tax on those dividends. Whereas if the company goes into the market and buys some of its shares, it is rewarding investors, but they don't have to pay tax on that. Now, to explain how that it is rewarding the other investors, if you think about a pizza with 8 slices, everyone gets 12.5% of the pizza if all the slices are cut equally.
Quick math.
Yeah. Whereas if you take, if you recut the pizza into 4 slices, then everyone gets 25% of the pizza. So as the company buys its own shares and destroys those shares, all the remaining shareholders own more of the company. So that means, that, as we always say, you're a partial owner of the company, and that one share that they still own, so the investor doesn't do anything, but it entitles them to a bigger percentage ownership of that company.
Yeah, they're just reducing the supply of
exactly.
the shares that are outstanding. Sounds pretty good for an investor. I mean, is it a good thing? Is it something that is looked favorably upon by investors and fund managers in the market?
So, short answer, yes. Investors love it because they literally sit on their hands and they own more of the company that they've invested in. So it's pretty widely loved in the investing community. We'll talk about some of the risks and some of the criticisms of it a little bit later, because there is a growing chorus of people that think that buybacks maybe aren't as good as as the theory suggests. But in theory, look, it's a pretty good way to reward shareholders.
Yeah, I think the chorus, as you said, is growing because a lot of stock valuations are progressively growing, and it's questions, is it the right time for companies to be doing these buybacks, buying back their own shares at record prices? But as you said, we can discuss that later.
Yeah. So let's frame the conversation. So buybacks have been in the media a lot recently, and that's part of the reason why we're doing this episode now. It's a really timely topic to be talking about. And the reason for that is just because we have seen an explosion of buybacks recently.
Yeah.
This has been driven by the tax cuts in America a lot, but really it's been longer than that. Since 2010, the US Fed had a quantitative easing program that was about, saving the economy. Essentially, they went into the market and bought a lot of bonds and troubled assets, and they spent about $4 trillion stabilizing the economy since around 2010. Companies alone in America have bought back $3.5 trillion in share repurchases.
That's staggering.
Yeah,
in the US alone?
It's a crazy amount. In the US alone.
Wow.
Yeah, just US companies. So,
wow.
Everyone's up in arms about the Federal Reserve and their quantitative easing program spending $4 trillion on, bonds and troubled assets and mortgage-backed securities and stuff like that. But almost just as much, 3.5 trillion, companies have spent just buying themselves.
Wow.
Yeah. Not adding any, well, arguably not adding any value in terms of like, the productive capacity of the economy or anything.
Yeah.
Just moving money around, really.
So I guess the question is, what other things could that $3.5 trillion have been spent on, do you think?
Well, plant and equipment, employees.
Yes.
Really.
Would you say that a buyback is reinvesting in the business in the sense of how a sort of Buffett explains reinvesting back into a business?
I don't think so. I think there's probably a distinction. I don't know what the technical answer is. Maybe the technical answer is yes, but you're not really reinvesting in the productive capacity of the business or the growth of the business. I mean, you are literally, I guess, investing in the business. I don't know. What would you say?
I would agree. My thinking of reinvesting back in the business is reinvesting in, as you said, something that is going to be driving growth or increasing production capacity if you're in that sort of space. So, yeah, I don't think so. I think it's a bit of a gimme in terms of returning value to the shareholder.
Yeah. Now, we've sort of questioned it a little bit. There is aside from being a way to reward shareholders, there is another sort of capital management reason for it. And when a company needs to raise capital to do a big purchase, a merger or an acquisition or something, they can issue new shares to the market and they can raise capital that way. And this is sort of the reciprocal side of that. If a company is issuing a lot of shares to raise capital, they also need the ability to then start taking some of those shares back off the market, because if the market is flooded, if there's such a large supply of shares for a particular company in the market, then it might be artificially keeping the price down low. Whereas if you start constricting supply of the shares, then it may actually, the price will go up. In theory, the price will go up commensurate with the amount of shares that you take out of the market. Yeah. But in some cases, it might actually rise more than that because the sort of glut in supply is taken away.
Interesting. So what are some notable examples of buybacks, Ren? We've spoken that, since 2010, it's been massive, but what are some companies, which companies have really gone for it and splashed their cash?
So I guess the biggest one has to be Apple. That's the one that everyone's talked about. We've probably even talked about it before on a previous episode.
Yeah.
But yeah, so they announced $100 billion buyback.
Ridiculous.
$100 billion. Like, that's more than most companies in Australia are valued at.
Yeah.
Yeah. So they'd already done $200 billion in buybacks over the last 6 years, and now they've announced this other $100 billion. We talk about Apple almost being worth $1 trillion now, but still $100 billion is worth 10% of their market cap, like 10% of their value.
It's huge. It's a massive buyback.
Yeah.
It's but they've been sitting on almost $300 billion in cash. So I guess their thinking is they've got to do something with it. But
my question is like, what? I get why you buy back shares, but like, what if they had bought another company?
I know Tesla.
Tesla's I guess it's not the obvious one, but it is. They're trying to push into self-driving cars.
Yeah.
Or Uber, Lyft. Uber's been valued at around $70 billion at the moment.
Wow.
They could have just bought Uber and still had money to spare.
Three times over.
Yeah, still done a $30 billion buyback after buying Uber.
Yeah, it's staggering.
Yeah, or like Fox, Rupert Murdoch selling 21st Century Fox to Disney at the moment. Apple's trying to get into the streaming game, but they have a real problem with creating content that's any good. They could have literally just bought content from Fox.
True.
Yeah, there's so many things, and I guess this comes back down to the age-old question of the opportunity cost of buying back shares.
Yeah, it's very interesting. So we've got Apple. Who else? Boeing. They did a massive one, didn't they? $18 billion back in 2017, December.
Yeah.
As well as increasing their dividend by 20%. So that's huge.
Yeah, that's massive.
Massive. payout.
Yeah,
So
yeah,
they're
yeah.
splashing cash. What else?
Another big one was Oracle. They announced a $12 billion buyback in December.
And then Cisco, they have $71 billion in cash offshore, and they're choosing to spend $25 billion of that for share repurchases. And combined with buybacks announced earlier in the year, the company is buying back up to 14% of its market cap.
That's just crazy.
Yeah.
It's so much of the company.
Yeah. I mean, yeah, it's an interesting one. To me, I don't know. I'm not. Yeah, I don't really have an opinion on whether or not these are good or bad because it's a very individual thing. But I know, Buffett definitely speaks about the importance of, he is a fan of repurchases, but only when it's sort of sensible in terms of its intrinsic value. If you're purchasing at below intrinsic value, he's all for it. But he also says, never forget that repurchasing the value and the price is the most important thing. And if you're buying at levels that are well above the value of the company, then you're probably making a poor capital management decision, which is interesting because, he's a massive fan of Apple and he's invested in Apple himself and they're spending 100 billion. So he obviously thinks it's a reasonable thing for them to do.
Yeah, well, I mean, if he's investing in them, he obviously thinks they're at a good price. So it makes sense for them to be buying back if he's right about the price.
Exactly.
So look, that's we've used a lot of American examples, and there's a reason for that. JP Morgan have predicted that 2018 will be the year of the most amount of buybacks in US corporate history. I think some of the reporting is that in the January to February quarterly earnings reporting, there was about $190 billion in buybacks, and then in the most recent earnings quarter, there was about $180 billion. So, it's just crazy numbers every quarter. Australia obviously doesn't play in that sort of field with those numbers. And Australia is a very dividend-heavy market. Australian investors, super funds, pensioners, baby boomers love dividends. So we don't have buybacks to the same extent. But we do still have buybacks. ANZ recently announced they're buying back $3 billion worth of their shares.
Interesting.
And that money came from the sale of their life insurance business. So, interesting that they're selling a division and they don't have anything else to do with the money, I guess.
Yeah, strange. Very briefly, as an investor, would you prefer your company to be paying out large amounts of high dividend yield or purchasing back some stock?
I would probably prefer purchasing back stock just because I think as a long-term investor, if they're buying back stock in their own company, then that has a long-term benefit for you because you own more of that company this year, but every year ongoing as well. Whereas the dividend is paid, that's a moment in time, and sure, you can invest it in a different company, but the compounding effect isn't there.
I would agree.
There you go. We're agreeing a lot today.
Nice.
So we've talked about, in theory, why buybacks are a good thing. There is a growing chorus of people that argue that the theory and the practice are a little bit different. Let's get on to the downside of buybacks, I guess.
What is the downside of buyback, Ren?
So the first bit is what we've already spoken about around the opportunity cost. If companies are buying back their shares, that means they're not employing more people, they're not investing in their plant and equipment, to become more productive or to start new lines or offer new services. So that's the first one.
Yes.
The second one is that companies are terrible at timing the market. So what we continue to see over and over again is that companies are buying at all the wrong times. So in The Economist in 2014, they reported that between 2006 and 2008, America's financial sector repurchased shares to the tune of $207 billion. And obviously that was the market top before the GFC. And then by 2009, the taxpayers had to inject $250 billion into the US banks to save them. So that $207 billion they used to repurchase shares maybe could have been used to shore up their balance sheets rather than buying back shares and then needing the taxpayer to bail them out.
It's an interesting one because to me, makes sense to, buy stocks when, the price is right. And as an investor, you kind of hope they do that. But then at the same time, as an investor, if the company that you own says, we've got $100 billion, but you know what, we actually think our stock's going to drop 50% in the next year or whatever, so we're going to hang 10 and wait for that. That sort of doesn't really instill much confidence in the investor.
Yeah.
So it's a tough one because they don't want to come across as poor managers of their capital, but in buying at the wrong time certainly gives that impression.
Yeah. And then I guess the last criticism, and the one that resonates most with me, has to do with the sort of the short-term nature of the stock market and of CEOs' incentives. In America, well, in everywhere, the heads of these big companies are held to quarterly numbers or annual numbers, and that's what their compensation is based on. If they hit an earnings per share number and stuff like that, and companies use buybacks as a way to massage their figures, I guess.
Yeah.
If your earnings per share is going down and you're getting towards the end of the year and you're about to report to the market, if you're buying back a whole bunch of shares, that can artificially bump up all your per share numbers and you can make them look better. And that's a classic example of that, using buybacks as a way to sort of pad their stats, was GE, or is GE. So between 2015 and 2016, bought back $45 billion in shares. And GE's been struggling for a while, and this buyback sort of made their numbers look better than it should have. But then they reported that they had a $31 billion hole in their pension obligations.
Good.
So they bought back $45 billion, and then they reported they had a $31 billion hole in their pension obligation. And what that meant in 2017, they told analysts that they had to cut CapEx, so capital expenditure, by 26%, and would need to borrow money just to pay 2018's pension obligations. And, you think like, you wonder how a CEO or a CFO, who obviously know what their pension obligations are, could spend all that money buying back shares. And the simple reason is, in a lot of these cases, because these CEOs and these leaders care more about hitting their numbers to get their STIs, their bonuses, rather than sort of, what could be argued is in the best interest of the company longer term. Yeah.
No, to me, this is the most dangerous one, but they'll never admit that's why they're doing it, but it's certainly the case.
And GE is a particularly egregious example. And it's been declining for a while. It got taken out of the Dow Jones, I think only this week or last week.
Oh wow!
So it's continuing its slow and steady decline from, it used to be one of the great American stocks. Everyone sort of owned it. I guess it was like the BHP in Australia. Everyone had a little bit tucked away. Maybe.
Anyway, Ren, we have blown the 15 minutes.
Have we? Oh gosh, time flies when you're having fun.
We've absolutely shot through that, so we'll have to wrap it up there, I think.
Yeah.
But good little intro into buybacks. There's not really much you can do as an investor. Companies announce whether or not they're going to be doing a buyback or not, and that's sort of going to give you an indication. But it's not really an investing strategy, I wouldn't say. It's just depending on how you look at it, it's an added bonus if your company decides to do a buyback or not. So, I wouldn't be searching for companies that are saying they're going to be doing buybacks.
No, I don't think so. There's probably some ETF out there that tracks companies that are doing the biggest buybacks and rebalances every quarter. Yep. So you could have a look for that. But, I think a buyback is good for you if you already own the stock, but I wouldn't go chasing it. Yeah, I agree with you.
Cool, Ren. Well, that's a wrap. We will update everyone on our trades for this state competition sometime next week. We'll be approaching the end of the 2 weeks by the end of next week. So we'll keep track of everything and then let all our listeners know how we go.
Yeah, sounds good.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.